Aviva is a multinational insurance company based in the UK. It focuses on providing life insurance, health insurance, car, house and travel insurance, as well as pensions. A quid research was conducted to map out the ageing problems within the space of the insurance industry. We can see that retirement and pension is one of the top clusters compared to every other insurance product in terms of both stories count and social sharing counts. This is why we have decided to focus on pensions. In this presentation, we will be analysing the impact of ageing on retirement and pensions on Aviva. We will also be providing an overview of what Aviva's competitors are doing in the UK and in the rest of the world. Before we proceed, we will briefly explain what pensions are. To summarise, they are an amount of money you save during your working life for later in your life. There are mainly two types of pensions. There are public pensions, which are given by the state, and there are private pensions, given by insurance companies. These are separated in two groups. Workplace pensions, which are arranged by the employer, based on an employee's salary and years of work, as well as personal pensions arranged by the person themselves. In 2014, in the UK, there were 6.4 million people paying into personal pensions. This is the one we will be focusing on as it is most relevant to Aviva and insurance companies in general. Let us now look at Aviva's pension plan. The minimum age to start saving is 18 and the minimum contribution per month made by consumers is £100. To start benefiting from this money, you need to be 55 years old. Once you start getting the money back, you have four choices: withdrawing all your money at once, taking some when you need, leaving the money where it is, or buying an income for your lifetime. This one may be variable as it depends on the invested in fund's performance. Therefore, it is called an income drawdown. It could also be a fixed amount called annuities. The latter means Aviva will agree to give you a fixed and agreed upon amount of money each year for the rest of your life. For the remainder of the presentation, we will mostly focus on both income drawdown and annuities. We will now look at the problem of ageing on Aviva's pension services. This quote from the Organisation for Economic Cooperation and Development clearly explains the problem. Pensions today are designed for yesterday's society. We will try to understand why. The global life expectancy increases as the years go by. This means when someone reaches retirement, they now need more money than before to cover the amount of years he still has to live. As there is no tangible way to estimate it, people underestimate the time at which they will pass away. This means, firstly, people could end up losing all of their pension savings, which could result in possible financial struggle for the last part of their life. Secondly, Aviva could end up paying more money in annuities, as they will have to pay over a larger period of time. Let's take the example of Johnny, who has started investing into his savings in his 30s. Each month, he invests 0.3% of his income into the savings account. According to Aviva's online pension portfolio calculator, by the age of 55, the age at which he can get his income back from Aviva, Johnny would have accumulated about £153,600. Here, we assume that Johnny decided to live on his savings without buying an income for life, such as an annuity. Johnny would be estimating his retirement duration period using the average life expectancy rate and take money from his pension accordingly on an annual basis. As the table at the bottom demonstrates, by 2030, Johnny would have a £1,000 decrease in his yearly drawdown compared to if he was living 15 years ago. As he is taking from his own money, there is not a direct problem towards Aviva's profits. However, it may cause reputational damage for Aviva in the long term, as the effectiveness of investing in pensions will decrease since people will have less and less money to live on annually. Assuming all things stay equal, if it reaches a point where pensions are no longer sufficient for retirees to live on, there will be a decrease in Aviva's pension clients. Secondly, our team explored the impact of increasing life expectancy on Aviva's annuity product. Using the same example of Johnny, we assume that he intends to spend all of his savings into buying Aviva's annuity product. According to the current Aviva annuity calculator, Johnny would be receiving an income of £5,995 annually for the rest of his life. Here, increasing longevity would cost Aviva more money, meaning an increase in Aviva's annuity drawdown. In 2030, Johnny is expected to live until he is 86, meaning Aviva would have to spend an additional £29,975 to pay for Johnny's 5 additional retirement years, compared to if he was living 15 years earlier. In order to maintain a similar level of profitability, Aviva must adjust their annuity drawdown for their new clients. For example, if Johnny were to purchase the pension product in 2030 at the age of 55, Aviva must decrease the annual annuity for Johnny from £5,995 to £4,957, according to our calculations from the previous table. This would prevent Aviva from overpaying on annuities. So how can people make sure to get the same amount of money even for the last years of their life and avoid Johnny's first problem? We have identified 3 main solutions: working past the retirement age, starting to save earlier or larger amounts during the working life, or finding ways to spend the pension more optimally. If we look closer at the first solution, for example, we see that 53% of retirees are already working full or part-time in order to supplement their pension, with 17% considering returning to work in the UK. Here is an example of how insurance companies could attempt to solve the problem of paying too much in annuities. Insurance companies could use big data to assess the life expectancy and the risk of each client, which they could then reflect in their income from annuities. As a matter of fact, lifestyle factors such as the amount of exercise a person does or the amount of alcohol they consume can have an influence on when they pass away. We will now look at competitors' pension products. Just to give an overview of the different rules each company has set concerning pensions, we decided to compare Aviva with the other major English insurance companies, Prudential, Legal & General, and Saga. We compared the minimum age at which each company allows clients to get the money from their pension back. It can clearly be seen that Saga has the lowest age. We also compared the minimum contribution per month that consumers have to pay. We can see that Aviva's contribution is half of the minimum contribution of its competitors, making it already more competitive. In terms of addressing the aging problem, Saga has announced they will develop a more personalised approach to pension plans to make it easier for the elderly to save. As a matter of fact, more than 12 million over 50s do not have a financial plan in place to ensure retirement is financially stress-free. It will provide ready-made portfolios for investors and a list of top investment funds drawn up by an advising team of 46 financial planners. It will allow customers to construct a personal money dashboard detailing their finances. In addition, they will be able to invest as little as £50 a month, which is convenient for those who weren't used to saving for pensions before. We will now assess the regulations around aging across the globe. This diagram illustrates the current pensionable age around the world. Government decisions reflect how the state adjusts to react to the aging problem, and one of the most common practices is to push back the pensionable age. This shortens the retirement period of retirees, ensuring that they will receive a sufficient amount of pension on a monthly or yearly basis, without having to actually increase the total pension amount. The UK has introduced several reforms in the recent years. Firstly, in recent years, the pensionable age was increased to 65 and it is forecasted to increase to 69 in the long-term future. However, people are permitted to work for longer if they desire. A default retirement age no longer exists. Furthermore, people are given complete pension freedom concerning their privately owned pensions, such as the one offered by Aviva. Let us now focus on Japan, another country majorly concerned by the aging problem as it has the highest percentage of over 60s. As there is a lack of young people in this country and an increasing amount of old people, Japanese insurers have decided to open branches in other countries where the population is on average younger. This is to compensate for the fact that having only older clients can get expensive and risky. They are therefore diversifying their client base. For example, in 2015, Nippon Life Insurance, which is Japanese-based, purchased an 80% stake in National Australia's Bank's life insurance operation. The same year, Sumitomo Life Insurance acquired Symetra Financial, which is US-based. As can be observed, those countries have a lower percentage of old people in their population and are still developed countries. In conclusion, we believe that pensions will be the sector of the insurance industry that will be the most affected by the ageing problem. Some competitors have already started addressing this problem, like Saga with its more elderly-friendly personalised plan for the over 50s. Moreover, other countries like Japan, where the proportion of older people is very important, are trying new strategies such as opening an insurance branch in countries where this rate is lower to compensate for the high level of risk related to aging. Thank you, and we